Hey, this is Drew Page. Welcome to the Drew Page channel. In this video, I'm going to talk about how to get started in investing through dollar cost averaging. If you are watching the market at all today, you saw one of the craziest days in the stock market. It started off with the futures being in the green. It got to a low point of red, 1,000 points, and then it ended the day up green by just a few points. So it was a huge dip of a day. And if you are new to the stock market, let's say that you've got a personal injury settlement, a big lump sum, and you want to get started investing and trying to maximize that money, or if you've got a bonus, or if you've got some new income coming in, or if you're just trying to get started investing in the stock market, days like today can really throw you off. So if you're new and you're not sure where to start, one of the key strategies to use as a beginning investor is dollar cost averaging. And we're going to talk about that in this video. But first, if you will, help me out, subscribe to my channel and like this video to help with the algorithms so that it can get out and help other people. So what is dollar cost averaging? Dollar cost averaging is when you have a certain set amount of money that you intend to spend over a set period of time by some part or some plan. That's the basic way to define it. There's, I'm sure, more technical ways to define that, but who cares? It's my channel, so I'll define it the way I want to. Let's say you're one of my personal injury clients, and I work it out where you get a lump sum for your personal injury settlement of $120,000. Now, since I'm new to investing, I may not want to dump all $120,000 in the stock market at one time. Although I will say that when it comes to my Roth IRA strategy, that's what I do, because some studies have shown that the earlier you put it in, whether the market's fluctuating up or down is irrelevant. If you're putting it in investments that compound over time and that pay a dividend, then it doesn't matter when you put it in, because in the long term it's going to expand. But maybe you don't want to put all $120,000 in the market. Maybe you want to put some of it into a real estate investment. Maybe you want to put some of it into crypto. And so if you're only going to use a portion of it, you want to make good use of it, and you don't want to put it in on the top of the market, and you don't want to miss out on a bottom. So you can use a strategy called dollar cost averaging. What that means is, let's say you want to put in a certain amount every 12 months. Well, let's say that you want to put in this $120,000, or you have a plan to dollar cost average over 12 months. You'd simply take that number, divide it by 12, and so you'd be putting $1,000 per month, maybe the first of each month, every single month, so that you can average it out. That way you're not putting it all in there at one time. And so you may end up not using this. If you decide to later use it for real estate, you can just keep this in a stored savings account of some sort, or a money market account, and just put $1,000 in each and every month, regardless of where the market is. And you may make some, you're going to get some good investment return over time by dollar cost averaging that way. Now, the strategy of dollar cost averaging I use personally with my money that's not my investment money, as far as like retirement, 401k, Roth IRA. Again, those are just automatic. I do the 6,000 automatic, and then obviously the 401k is tied to my income. So my hands are kind of tied on how much I could do. If I could, I'd put all 20,500 in the year 2022, which is what's allowable for this year. I would put it all in January. But for my funds that I'm trying to grow with my bonus money or extra money, or money I have left over in my budget, the way I dollar cost average is this. Any day there's a red day. Any day. Whether it's negative $100 in either the Dow or the NASDAQ, if it's negative $1,000. Anytime there's a red day, I match the number of dollars that it's down in either the Dow or the NASDAQ. I don't use the S&P, because generally the S&P, it doesn't fluctuate enough to put a monumental investment in. But let's say that the Dow, like today, was 1,000, and if it closed that way, and the NASDAQ closed at 369, I would take the larger of the two and put that amount of money in. And it doesn't matter what day it is. And let's say it switched. And the next day, the Dow was at negative 369 and the NASDAQ was at negative 1,000. Then I would put $1,000 in there. And so that's how I dollar cost average. And you say, well, why not just wait and see where the bottom is? And I'll tell you, the reason why I do it this way now is because in 2020, we were told that the bottom that hit in March of 2020 was not the real bottom, at least by some economists like Mohamed El-Erian. He said, oh, there's going to be a second bottom, just like there was in 2009 after the 2008 financial crisis. There was a second bottom that was actually deeper than the one in 2008, and that's what Mohamed was calling for in the pandemic in 2020. He said, oh, there's a second bottom. So I kept waiting and waiting and waiting. And by the time we got into May, which is a month after he was saying, hold on, there's still a second bottom, I started to figure out that second bottom wasn't ever coming. So I got back in the market, but I missed out on being able to get good buys at the bottom of the market. And so the lesson I learned is buy all the way down. And you know, there's people say all the time, oh, don't buy the falling knife. You're going to catch the falling knife if you buy all the way down. Eventually the knife stops. It's not a bottomless pit. It has to reach bottom at some point. So as long as you're not putting everything in at what you think is the bottom, you're fine. Now, maybe at some point you run out of money. Okay, well, eventually it's going to come back up. But the more bottoms that you're hitting and buying on each of those red days, eventually it's going to give you a return. And that's the lesson that I learned from 2020. So this idea of dollar cost averaging, that's my plan. That's what I do. Anytime that there is a red day in either the Dow or the NASDAQ, whichever number is the largest negative number is the amount of dollars that I put in. And so if you get a big settlement, you don't have to worry about, timing the market. You don't have to worry about throwing it all in and trying to wait for a bottom. Have a strategy, whether your strategy is to put in a little bit each month, or if your strategy is like mine and you put in on every single red day. Now, I'm not your financial advisor. This is just how I do things. Obviously, you have to figure out your own strategy, but this is what I do. And I'm not telling you need to do what I do, but I don't want you to just lose this money. I want you to maximize it. If you're one of my personal injury clients, I want you to not only get the settlement that I'm able to help you get, but I want you to maximize it, because I want to be able to help you make more money than what the insurance company is giving you, because you've been through it. You deserve it. And I want you to be able to flourish and to be able to grow your money. And then that way you'll send more people to me, because you know that I will help them, not just so that I can get my piece and my percentage of the settlement and of the verdicts or whatever, but that I actually give back and help you even after you've gotten the money. So I hope you found this video helpful. Please put in the comments what you think of the dollar cost averaging strategy. Do you agree with it? Do you disagree with it? How would you do it differently? If you found this helpful, please subscribe to my channel, like this video, and until next time, stay tuned.